From Chicago is David Herro, Harris Associate CIO of International Equities. He co-manages 4 Oakmark funds, including a $35.5 billion Oakmark International Fund. His biggest allocation in that fund is in the UK. Do you add to that position, David, on the weakness and on the uncertainty that we see?
If the weakness and uncertainty means lower prices for businesses despite positive business development, that becomes a reason for us to add to our positions. We have to make sure we have a good notion, a good idea on what the intrinsic value of a business is, despite what's happening in the macro environment around it. These are all inputs that go into our valuation process. And if price drops significantly and value doesn't, yes, this becomes an opportunity.
So, David, how clear is the link between intrinsic value, because that's something you focus on for companies with the intrinsic value, and the macro effects? For example, did the intrinsic value of UK companies overall go down after the Brexit vote?
The share price certainly did, and in most instances, you did not see a major decline in intrinsic value. Intrinsic value is a function of the cash flow stream of that business. All the cash flow stream, today's, tomorrow's, discounted to present value. And this is the big opportunity for an active investor, because Mr. Market trades on minute by minute, hour by hour, day by day, noise that is in the geopolitical atmosphere, whereas an investor measures value based over medium and long-term prospects. And when price divorces itself from this reality, it becomes opportunity. And something like a Brexit, or something like the Italians fighting with the Europeans, any kind of political instability often is more noise than actually impacts the fundamental ability of a business to earn money for its owners.
Okay, so David, if you wind up seeing the value right now, where specifically is it? What stocks, what sectors?
If you look at where we're weighted today, you see a heavy weight towards European financials. It's a broad mix of financials from banks, insurance, asset management companies. And what has happened is all this political noise, every time it gets cranked up a couple decibels, people use this sector as a way to play the noise by shorting it or by selling these stocks, and thereby making them very valuable.
But justifiably, because a lot of them have NPLs, particularly over in Italy. I mean, Santander is sort of in the hot seat today with its convertible bonds. Like, there's a reason why it's the proxy.
Well, it's a very poor proxy, because you bring up NPLs. The NPL situation in Italy in the last 2 or 3 years has significantly improved. And if you look at the quality European banks, a BNP, an Intesa, a Lloyds, look at those NPLs. They've barely moved, if at all, in the last 2 or 3 years. This is the point I'm trying to make. There are aspects to this which impact the bank's fundamentals. For instance, if this uncertainty means lower rates for longer, and that delays interest rate normalization, this generally isn't good. If it means, for instance, that the banks aren't going to be able to grow because of uncertainty, this isn't good. But NPLs are down, costs are down, fees are up. Earnings have basically maintained at acceptable levels. They're not booming like we'd hope they were to be, but they are still growing, albeit at a slow rate.
So, David, let's talk about rates and the ECB specifically, because obviously if you've got negative interest rates, that's not helping the banks over there. What is your time horizon you look at that? Because it was thought that maybe the ECB would be moving more toward normalization. It looks now like that's going to be put off. So what's your time horizon for when this actually has to turn around to make it worth your while?
Well, you're exactly right. I think there was a belief that there would be normalization starting sometime last year. And it looks like it might not even start this year. It probably, if the economy picks up, if it holds together in Europe, and by the way, the European economy is just muddled with structural problems that, would be easy fixes if they understood supply side economics in Europe, but I don't think they do. But anyway, so the problem is growth. You can't normalize your interest rates until you get a firmer footing on growth. And hopefully this happens with some of these trade disputes getting put in the rearview mirror, because European countries, especially Germany and even Italy, are big exporters, and big exporters to places like China. So as soon as growth kind of picks up, I think you would see a resumption in the normalization process. There's been a little resumption in terms of quantitative easing, which they have backed off on.
So, David, let's turn to another area where you have a pretty heavy weighting. That's automobiles. Doesn't seem there's going to be growth there, either in the United States or more globally, anytime soon. We had Peter Scheer from Academy Securities on just yesterday. This is what he had to say. He really had a warning about automobiles. This is what he said.
Right now, it's easy to blame a lot of the woes of the auto industry on tariffs and trade wars. I'm not as sure that 100% of the auto war, problems are related to that. I think there is some, overpurchase, that saturation in certain countries. So we need to clear up the trade wars.
So, David, as you know so well, there's a softness in demand pretty much wherever you look around the world, including in China. At the same time, huge investment required for electrification, for autonomy. Why is that a long-term sensible investment?
Because they've actually been investing now for the last 2 or 3, 4 years. In fact, we're getting more towards the end of this R&D phase, this investment phase for electrification, for autonomous. The automakers are actually starting to get a little wiser. They're going, instead of doing this all on their own, each company doing it on their own, they're starting to develop cooperations with each other, spread some of this investment pain around. And of course, the market isn't booming. The market isn't robust. But the market should still grow over the next 2 or 3 years. Yes, we have some structural issues, we have some cyclical issues, but you also have to look at the price you're able to buy these businesses at. And when you see a company like Daimler trading at 5.5 or 6 times earnings, still earning good profits with $17–18 billion of net cash on their balance sheet, with a very, very strong brand name in Mercedes-Benz vehicles. I'm not saying this is a business that should trade at 14 or 13 or 15 times earnings, but 5.5. You have to look at the price you pay for what you're getting. And the global investment community has left this sector for being dead. And I think there is some reason to be excited over medium and long-term prospects, especially given that most of the leaders of these businesses, the leading companies of these businesses, have invested for the future.